with us. Obviously, we're going to talk about real estate today and the opportunities in the Canadian market and what's been going on with COVID and real estate and all of that. And I have with me here Human Tebesh. He's the CEO of Alliance REIT. He has over 16 years of experience in developing and managing residential real estate. The Toronto native, Human has a deep personal connection and passion for the Toronto neighborhoods. And that translates well in his role as the CEO of Alliance REIT. Previous to founding Alliance, Human was a strategic advisor to board of publicly listed companies and REITs, and also held senior legal and asset management roles at Mackenzie Financial, BMO, and BlackRock Canada. Kenny Albert is here with us. He's a trustee at Alliance REIT, private equity investor and community activist. Previously served 23 years as president of a subsidiary of the Kilmer Group, focused on growing and diversifying Kilmer's interests in the sports, entertainment, and media sector. Speaking about that, by the way, Kenny, we are on November 22nd in London, our London Family Office Conference. We have a special sports panel with the CEO of the 49ers and the head of the UK league team and lots of folks. So prior to Kilmer, served as Vice President of Marketing and Sales for Canada Games Company Limited, one of Canada's largest games distributors. So again, good morning. How are you doing? How is it in Toronto today? Here we have nice sun and nice day here in New York.
It's raining. It's raining today.
Oh, raining. Okay.
It's all good, but at least it's not snowing, so it's all good.
Yeah. So I guess we'll talk about the Canadian real estate market and the opportunities you're seeing, and you obviously are focused in Toronto. So maybe tell us a little bit about yourselves and Alliance REIT, and then we'll ask you a couple of more questions once we get to know you a little bit better.
Sounds good, Danny. Thank you. And good morning, ladies and gentlemen. As Danny mentioned, my name is Human Tebesh. I'm the founder and CEO of Alliance REIT. I'm joined by Kenny, who's an independent member of our board of trustees. I have a short presentation, so if I may share my screen and maybe go through a couple of slides about what we do in Canada and Toronto specifically, then we could kind of move into the Q&A section. Here we go.
And if you can also, after you explain a little bit about you guys, and before we dive into some of my questions, it would be interesting to hear how you see in general the Toronto real estate market, and how did COVID affect it, positively or not, or valuations are better or higher. I know there's a tremendous growth in real estate in Canada in general. I wonder how COVID affected that. I can tell you that the lawyers we're talking to, as I've mentioned, as I forgot to mention, some of you may know we also have a sub-conference dedicated to real estate and family offices that we've been doing with Stikeman. This is a sub-conference of ours that just focuses on real estate for family offices. So my point is, when I was speaking to them, I can tell you they are as busy as ever. So I guess stuff is going on, and but we would love to hear it from you. Take it from here.
I want to answer all of those questions, but let's get to it. Let's just talk about what we do, and then we could, move into it. So for the lawyers,
you know what? Sorry, hasn't even started to speak, and I'm interrupting him already. I think we should also set the table on who we are. Like, don't ask me any real estate questions. I'm not a real estate guy. I'm a long-term family office operator here in Toronto, doing private equity, and I come, as Human says, as an independent director with not a lot of real estate background. And so bringing him the experience that we've had in the private equity world in both real estate and sports and media and all of that, as an advisor to Human. Human is the expert in real estate, and his whole career has been leading him to this point. So if there's Q&A later, ask Human the real estate questions and me the investment questions.
Thanks, Kenny. So for the lawyers in the group, here's some disclaimers. The investment is only available to accredited investors, and there may be some forward-looking information. So what's Alliance? Alliance is a private REIT that was established 5 years ago to provide investors with exposure to premium multifamily residential real estate in Toronto. We build elevated living spaces in boutique properties and very much focus on dynamic gentrifying neighborhoods that attract discerning residents and as a result tend to outperform the market. So what's the idea? The idea is we convert legacy Toronto assets into their best use. Toronto, as you could imagine, it was called the town of York, established in the 1800s. And there's a lot of buildings, much like New York, really in the downtown core that were built in the turn of century. These are beautiful double brick and beam buildings that have the square footage, but are not really at their best use. So we purchased those properties and we created loft-style boutique residential living spaces in the downtown core. In addition to that, corollary to what we do is we also build a portfolio of valuable land assets. Really in really strategic locations in Toronto that are only going to be intensified from investment perspective. The thesis, again, to reiterate, it's a best use conversion of assets. In a single family home that is, on a lot that's 30 by 120 feet in a downtown Toronto is not the best use of that asset today. The best use of that asset is conversion into a multifamily building where instead of one family living in that building, we could have 3 families living in that building and enjoy that neighborhood. In addition to that is de-risk land banking. So every property that we own and that we hold is, again, it's occupies a lot space of anywhere from 20 to 30 feet wide to 120 feet and backed by a laneway, which we also have the potential to build laneway housing in the future. And we also focus very much in niche market development. We pride ourselves in being very specific in our strategy, and it's a strategy that not many large players focus on. So we get to be the big fish in a small pond, essentially. Moving forward, so what's our secret sauce? We are vertically integrated. We preserve and add value at every stage of development, from acquisition of the property to development to tenanting and then to property management. All that is done internally with a very specific focus of creating and maintaining an elevated boutique loft style space that attracts discerning residents that will always pay the rent and will take care of the property. These are some of our properties on the left. As you can see, they're mostly detached and semi-detached properties. Those who are familiar with Toronto, everything is south of Eglinton, between Spadina Road and Weston Road, which is really kind of Toronto Central and West, very close to the core. And if you look at the map on the right side, that shows you our primary and secondary areas of interest that we focus on. This is another one of our buildings on the left, which is in a very prestigious area of town in Forest Hill Village. And on the right, you see the graph, which essentially charts the Toronto real estate market versus the S&P TSX Index in terms of performance. This is our performance specifically. As you can see, we started back in 2016. We very much track the Toronto real estate market, but thankfully we've been able to outperform it. And as you see, the other lines show the S&P TSX, the Capped REIT Index, and the Toronto Home Price Index. So we've been very lucky. We work hard at being lucky, frankly. We work very hard, and we've been able to kind of maintain that performance throughout the past 5 years. This is my management team. These are people that I've been working with for the past 6 years that I've trained myself and who are very much dedicated and owners themselves. And along with our esteemed board of trustees, Kenny, who needs no introduction, and we have lawyers, we have head of products, we have asset management expertise on the board who advise me on a regular basis. That's it. That's some of the parameters that I find, but I'm going to stop sharing and now I'm going to answer questions, Danny.
Thank you. So couple of questions that came here on my phone were the size when you guys started, the size of the fund, then how it was constructed, what kind of investors you've had, and a little bit about that before my question, which was how did COVID affected or not the real estate market?
Well, it affected a lot. I mean, obviously, it decimated the retail market. It affected the office space. It affected us in that, we have a lot of young professional residents. So they stopped going to the office. So what we had a lot of turnovers. We had about 10% of our portfolio who turned over because these were guys who gave us their 2 months notice, saying, well, I'm going to go move back home with my parents. I don't need to be here because I can work from home. What we found, which was, again, we're privileged, is that as soon as we got those notices and as soon as we put our units on the market, they were immediately rented. We found that folks, all of our units are typically in 3 to 5 plexes, large square footage of each of our units. A lot of outdoor space. So we have rooftop decks, we have backyard space. And what we found that people were essentially, moving away from the high density condos and apartment buildings and were looking for apartments like ours. So we found ourselves fully occupied throughout COVID. We obviously pivoted in terms of, property management, in terms of being able to kind of have our team go into each unit, and we came up, with protocols of make sure we protect our tenants. And but we found that thankfully, we were fully occupied. And another thing I found, Denny, is that many people before COVID never used their ovens. We got calls from people just starting to cook at home because everyone's sitting home. But aside from that, COVID didn't affect us from a financial perspective. It just showed us that our units are more in demand relative high-rise buildings and more dense environments.
And how do you see, by the way, it's a little bit off topic, the office space trends in Toronto?
Everyone's going to a hybrid. I mean, I'm not an office expert, but what I know is just from our own residents is that everyone's going to a hybrid model where instead of being there 5 days a week, people are going and kind of signing in and sharing it like 2-3 days a week. Recently, the head of one of the major banks, head of CIBC, just came out and said that that's not sustainable, that people need to be in the office. So my expectation is that people are going to get back in the office, if not immediately in the near future, particularly people who are in the early stages of their career. Because as someone who runs an operation, I could tell you that the people who are around me and who are visible are the ones that are going to get promoted. So anyone who is in the early stages of their career, in my view, is going to want to go back to the office because those are the people that are going to be more visible. They're going to be more in a collaborative environment. So my expectation is that office will be back in the next 6 months. I don't know, but soon.
And when you see, where I live in Rye, you saw people moving out of New York, storming location, places like you just showed us, that kind of locations, and prices are up the roof. And even if they go back to the office, I'm not sure how many would move back to the big New York City for now, at least. I think they enjoy the high, the suburbs and what it brings and the good, instead of being in the city. How do you see that? Do you see the same trend? Because you said it didn't affect you that much. So prices didn't go up the roof. People didn't come storming out of Toronto to more the nicer green suburbs.
I think you've got to remember that Toronto's a little bit of an anomaly. It's different than New York, and especially within Canada, it is the anomaly. This is the center of the country. That's where all the headquarters are. Or a lot of the headquarters. So there's a different dynamic going on here. In the office space, you look at the vacancy rates. Sure, they've gone up a little bit, but it's just transient. The numbers show that 100,000 people every year are coming into Toronto. They've got to live somewhere. They've got to work somewhere. So that from a density perspective, I see no problem in the office space world. The same thing occurs in real estate. And that's why I love what Human is doing, because it's in a niche. There's so much money chasing high-rise condos and bigger developments. On the Kilmer side, we're doing developments where we're building 3,000 units, 2,000 units. Lots of money chasing a high-rise rental income. This is a niche that's filling a very good void where there's not a lot of people doing it or chasing it professionally. And there's a huge demand for people living it. So I think the niche that Human is in is a little sheltered from the macro events that you're talking about.
Got it. Somebody's asking here, is this a GP-LP fund structure?
It's a real estate investment trust, so it's a REIT, and it's managed by externally by our company. So investors could come in, subscribe for units of the REIT at any time, and they could redeem anytime. So it behaves much like a public REIT, except it's a private REIT. So it's open to redemption and subscription any one time. We strike a NAV every month, so there's valuation each month. So folks who purchase or redeem, they do it based on the latest valuation.
And I have my own questions. I didn't even get to that yet, but maybe quickly 2 questions from folks here, and later, and the rest we'll do when we're done. Yeah. So, do you invest outside Toronto and outside Canada? In Panama, for instance, I think the answer is no, but I'll let you answer that. And what are the fees, MER, any performance fees?
Sure. So we focus very much in Toronto. We have plans. Our strategy to replicate it in different parts of Ontario as well, in different cities such as Montreal. However, our focus right now, because of our size, is in Toronto. We still see a lot more opportunities in Toronto. We are the most experienced, I want to say, in as far as people that I know. People that I don't know, but from the other players, you're most experienced in this very specific niche that Kenny spoke about. So we still see a lot more opportunities in Toronto. As we grow, there's certainly opportunities to move in other cities in Canada. We don't have any plans to go outside of Canada. Our expertise and strategy works here, and we intend to stay here. In terms of fees, we charge a 2% management fee on the equity of the fund. So the amount of equity is essentially a management fee of 2%, and we have a carry of 20% of the gains, subject to a 7% year-over-year hurdle rate. So to the extent that the value of a property has increased 7% year-over-year, the management company earns 20% of those gains. So it's very much like a private equity model of 220.
And okay, I think that answered that. And we'll address the rest of the questions later on. Let's start with, what do you attribute your performance to?
I think the vertical integration very much. I mean, let's step back. We're in a very niche market. We started the fund. This was an early question of how we started the fund. We started the fund really as a solution to from my own. I wanted to deploy my own capital into income properties, and that's how I came to this space. And one thing I discovered is that it wasn't being professionally ran, and the objective of Alliance REIT was to take something that was up to now very much a mom and pop operation and kind of bring this institutional discipline into it. So our success is really because of our discipline at every stage of acquisition, development, tenanting, and property management. We bring a lot of discipline and a lot of processes into our operation. And we make sure our parameters is we only maintain a 60% leverage. We only target properties that are going in cap rates 5%. We as great as the property is, if the financial modeling doesn't work, we don't go near it. So that's what I would say. Thankfully, what we owe our performance to is our discipline.
And how do you fare throughout COVID? You mentioned that it didn't quite affect you, but still.
I tell you how it affected us. So there's two parts of our business, right? We are also, aside from a residential REIT and a property management operation, we also develop, because we develop all our own properties. We don't buy properties that are already kind of like tenanted. We build a property, we develop it, and then we tenant it. So what affected us most, frankly, was scarcity of labor and scarcity of material. Throughout COVID, as you know, there was a big disruption in supply chain. So what we found is that cost of lumber, for example, there was a period in the summer where we couldn't find lumber, to build our units, and labor, frankly, for different reasons, as those in Canada know, was also very scarce. So in terms of our development side, it definitely increased our costs. But on the tenanting side, as a residential and the property management side, we found that throughout we're fully tenanted, and thankfully, and this is really, it's thanks to our residents. We take a lot of care in choosing who our residents are, and also to our property management team. We were able to collect pretty much near 100% of our rent throughout.
How do you use leverage?
So we try to be very disciplined. My own experience from being an advisor to other real estate companies is that real estate companies fail when they take too much leverage. So we maintain a maximum of 60%, and actually often are well below it. Right now, we have a leverage of about 52%. So from a performance perspective, it's not very efficient, but at the end of the day, we are fiduciaries of other people's capital. And we want to make sure that, we never risk it. So we use only 60%, maximum 60%. Typically, our model is we buy our development properties in cash, in equity, so that we could avoid paying construction financing, which is obviously much higher than regular financing. And then once it's tenanted, then we just get regular financing, and we have relationship with many different institutions, and we tend to get preferred rates. But our leverage on a portfolio is always below 60%.
Where do you see the rental market going?
In Toronto, as Kenny said, Toronto is unique. I'm an immigrant. I'm a first-generation immigrant myself. It is a destination. Canada expects to allow, and I don't know the exact numbers, but it's upward of 400,000 immigrants, net immigrants in the next year and going forward. When I first moved to Toronto was about, I would say, maybe 1/4 of its size, and that wasn't that long ago. It's a fast-growing city. It is becoming denser and denser as time goes, obviously, inevitably. And as those of us who've lived in other countries in Middle East and Europe, we know that there's no such a thing as having a white picket fence detached property within 5 minutes from the core of the town. In Toronto, you still have that. So our Alliance REIT's objective is to take advantage of that land value that exists in Toronto, because that in my mind, that land is only going to be intensified because of the population increase. And when population increases, there's more demand for rental.
There was an interesting article in the Globe and Mail this morning talking about people investing in real estate, and the prices, especially in Toronto, have gone up dramatically in the last 20, 30, 40 years. And you look at the ability for people to enter the market, it's very difficult. That's why we're able to buy inventory. If we had more money, we'd be able to buy as much as we wanted. But the retail market, people, new families, new homeowners, they're not getting into the market, so they can buy into a REIT like this, and they're renting. And I find a lot of my kids are not interested in owning a home right now. They want to rent. People are a lot more willing to rent in this millennial generation. And I think that's an opportunity why I think the rental market will continue to grow.
Just before, and how do you see the general real estate market in Toronto? You talked a little bit about office space. But in general, where do you see the real estate world in Toronto going?
It's value is driven by scarcity, right? Talking about real estate. So Toronto has a very unique, I guess, geographical features. As Kenny mentioned, we're the headquarters of most major corporations in Canada, if not the world. Pretty much, our best university, the biggest universities, I don't want to offend any other city, are in Toronto. One of the major health networks, in biotechnology, is in Toronto. So it is a net absorber of talent. Yet it is surrounded by lake on one side and a green belt on the other. So in terms of livable space, is very much limited right now. Very much like New York, Manhattan, where it's an island, and we have a lake on one side, and we have a green zone on the other. So in my mind, it's land. It is only going to go up.
And I would add to that, there's some gray hair on this call. So we've been through these cycles. We're going to continue to go through them. I think what's going to happen specifically in the Toronto market, it will be less impacted by a downturn than other markets, for example. If you look at, we were just talking office vacancy, look at office vacancy rates in Toronto versus Calgary, it's night and day. So I think Toronto is going to be more resilient on all levels of any kind of downturn, be it real estate, stock market, currency, anything.
I couldn't say it better myself, and just to repeat what Kenny said, and that's why we focus in Toronto, because in our mind, Toronto, it is not going to be impacted by downturn as much as cities like Kitchener or Hamilton or the more secondary markets.
I'm getting questions in different methods. So on my WhatsApp, I have a question. How federal and provincial new rules affect your REIT? Because during COVID, you're not allowed to raise the rent or evict tenants.
Yeah, so thank you. And this is why vertical integration is such an important part of our business, in that we really take, we build these units ourselves. So all of our units are new built. They're hardwood floors. If you go on our website, there's pictures of our units. I mean, these are really elevated living spaces that what I tell my crew is that we want to create spaces that I myself want to live in. So when we put these on market, we don't charge the highest rent, we charge fair rent. So we get our selection of applicants, a big selection typically. So then we have choice into who we want to reside in our places. And the people we pick obviously are, people who've been, are creditworthy, who have sources of income. Typically they're young professionals and people who just graduated from professional school and who are going to afford their own condo, in the next few years. So what we found is that it didn't really affect us. I have to tell you, in the 5 years, 6 years of running this REIT and 20 years of doing this myself on my own, I've never had to evict anyone from not paying rent. There's been issues with noise and other things that, between neighbors not getting along, but never from people not paying rent. So throughout COVID, we were able to collect the rent. We didn't care to raise the rent. That wasn't, an issue for us. And we didn't have to evict anyone. So it didn't, that provincial or federal regulation didn't affect us.
Do you plan to expand to other markets, and when?
So we touched on that. Part of our strategy, as I said, is managing the properties ourselves. And because our properties have smaller footprints, in order for us to expand to other markets, we need to kind of be able to accumulate a small portfolio first, so be able to replicate our team. So that's why for now our focus is in Toronto. However, as we gather more resources and as we see more opportunities, there are other cities that we are absolutely considering within the vicinity of Toronto. As I mentioned, Montreal. Those are areas that I think share elements, features of Toronto that relate to our strategy. But as of this particular moment, we still see a lot more opportunities in Toronto. So we intend to stay here. However, there will be cities in the future as we gather our resources to move to. Yeah.
As a trustee of the REIT, it would be a very, very long and hard conversation before we would expand beyond our current strategy. It's working, and this is not a situation where you want to diversify your risk by geographic region. It's a different model. If I was buying office spaces, and I wouldn't want to concentrate on one city, because you need to have the ups and downs of the different cities. This is a different model. So I think focus is very, very important here. And we've got tons and tons of growth opportunity here in Toronto before we look at splitting our time in another market. I'm open to it, but it's going to be a tough conversation.
I agree.
Is your sole focus development of low-rise purpose-built rentals, or will you also develop larger properties?
Thank you. Our focus is boutique loft-style elevated spaces. Often they come in smaller triplex, fourplexes, because we're able to have backyard space, we're able to have rooftop decks, etc. However, there are many buildings which I call pre-war buildings, typically built in 1930s, 1940s, which are triple brick beam buildings, typically bigger footprints, etc., that are also loft style and fit our brand. So we would certainly, as we just purchased a property that's 31 units, as you saw on our deck, that fits our model, that attracts the kind of residents that we want to attract. So I think that's what it comes down to. Is our unit going to attract the demographic that we're targeting? And that's when we build that property. So I don't think we would ever get into a 12-story brick cast concrete building, because that isn't a focus strategy for us. For us is to be able to attract a young professional who is making six figures and who wants to live in an awesome place, close to the core, and be close to all the amenities. Those are the buildings we focus on.
And Hooman, I would add to that to say that the larger buildings that you're talking about, Denny, are so competitive and so sought after. There are family offices in Toronto that are just chasing after these as generational assets, not caring it. I'm not saying not caring, but essentially overlooking the cap rate that you could justify as a place to park money. The strategy here is something we can acquire at a good price, own, operate, and generate cash flow on, and have an appreciation value. And I think that the other thing that we haven't even talked about here is the liquidity and flexibility of this kind of portfolio. We're talking single family units or a building of 3 stories with 30 units. These are easily transactable. Correct me if I'm wrong, man. We haven't had anybody cash out their units, but we easily could and not use our capital to pay that down. We could easily sell properties if anybody's looking to exit. So it's a different beast to chase those larger properties, and the development properties. That's a whole other world. There's huge families and huge companies doing those 1, 2, 3, 5,000 unit developments.
You're a private REIT. What kind of governance practices and investor reporting do you have?
Thank you. So we're governed by the Ontario Securities Commission. So we report to the Ontario Securities Commission, also obviously by CRA, which is a tax authority, federal tax authority in Canada. By virtue of the fact that we are RSP and TFSA eligible, so people could invest their registered money in us. We have a number of reporting requirements. So we're audited annually. So we have an independent auditor that audits our financials. Investors receive quarterly statements of their valuation of their units. Obviously, we have a board of trustees that manages and advises and watches what we do as management. And we have newsletters. So I come from a background of asset management. And what I believe is that unit holders, as owners of the REIT, should know the good, the bad, the ugly. So I think every 2 months, I try to have a newsletter that essentially in detail outlines what properties we have, what are we working on, how much have we rented them, is there any issue that as an investor would want to know. So aside from the regulatory aspects of being audited, providing quarterly reporting and annual financials, we also provide bi-monthly reports to our investors.
I think you glossed over the governance section of that and the responsibility of the trustees. And I think Hooman can attest that I am a stickler or picky or I'm brutal on governance. It's very important. We do have a fiduciary response. Of course, I'm invested as well. And I've got to look other LPs in the eye to say, yes, we are watching this business on a weekly, daily. We had a board meeting yesterday at one of our properties. It's very, very important. Trust is everything. Our reputations are everything. And we've got people that we know and like as investors in this company, and I take that responsibility very seriously.
Absolutely, and I'm indebted, and you're right. As management, it's easy for us to get caught up in the day-to-day operation, and I rely on the board and Kenny and the other board trustees to kind of bring that oversight, and I value their input, and they have amazing input, and and Kenny said it's everything the board dictates, I follow.
We have lots of questions, so let's start. I think you answered that as well. Do you plan to expand to Victoria, BC, Vancouver, Langley, or any other cities in British Columbia?
So to expound on that, one of our key success factors is our knowledge of the neighborhoods in Toronto. Toronto is a city of neighborhoods, right? So the reason we've been able to outperform the Toronto market is because we focus on neighborhoods that outperform the general Toronto market. Back when I was younger and hip, I knew which areas of town, were the areas where young people want to be in. So that's what we pride ourselves in. We want to be where young, mobile, upwardly mobile young individuals want to be, right? So it's about identifying those neighborhoods and going and essentially building the neighborhood before the gentrification stage hits. And so far, we've been able to make good bets, and we continue to make good bets. Toronto's expanding, and so are its desirable neighborhoods. So for us to kind of move to another city, we would need that expertise in that city. And I don't have that expertise in Vancouver or in Victoria, but we do have that expertise in Toronto. And as Kenny mentioned, we still see ample opportunities here. So our focus right now is to stay in Toronto.
If the property market crashes, how will the investors be affected?
Well, it's interesting. Let's say there is, so I believe, so if I'm putting my crystal ball in front of me, it's like, so what is going to be the major driver of a downturn? I won't call it a crash because I can't find a reason why a property doesn't crash, but I could find a reason why there would be a downturn. And I think the downturn would be higher interest rates. I think if the Bank of Canada comes tomorrow and decides to raise the interest rates, we will see an effect on the price of properties. So what would happen is maybe the value of our properties would go down. So the NAV would go down. However, I could assure you that our rents would go up because people can't, if people can't afford their homes because interest rates are going up, they still got to live in the city. They still have to rent. So I think we will be fully occupied, maybe at lower valuation of our properties. But again, looking at my crystal ball, I would also suggest respectfully that I would be a temporary state because from a population growth in Toronto, I can't find a reason why there will be a crash. And Kenny, I don't know if you want to add to that.
Two things I would add to that. One is this is not the stock market. So if you're playing for ins and outs on crashes with real estate, and this is not for you, this is a long-term investment that over 100 years, you can look back, has gone up that sure, there are blips, but it ultimately goes up. I think that the biggest thing about a downturn is going to create a distinct opportunity for us to buy many more properties at a lower price and spread out. We have a large portfolio of properties, so we have the ability to buy even at higher interest rates. We'll be fine. So I'm not saying I'm looking forward to a downturn for many reasons, but I think it would create a tremendous opportunity in the market for us to buy additional properties at an excellent value and have that little dip come out and be far more strong coming out of it to have a greater increase in the NAV.
Thank you.
Could you please post the PDF presentation? That's this is being recorded, so the session of this you'll be able to watch later on.
If folks, I mean, so Danny, if folks go on our website, there's emails there, and if they could email us, we'd be able to send them the full presentation. So our website is www.alliancereit.com, so alliancereit.com. And there is a contact us section. So if you send us an email via our website, we'll be able to provide them with the information they need.
And as you said at the beginning, Hooman, this is only open to accredited investors. So I think just posting or sending out the investment deck would be inappropriate.
Thank you.
We definitely will get the compliance part. We see how that is something you guys take very seriously. What is the REIT percentage of non-payments?
Percentage
of non-payments.
In terms of rent?
I assume.
No. I think the question is thinking about distributions. If a REIT has a history of putting out 1% per quarter, etc.
Thank you. So as a trust, it's a tax efficient structure. So we do have to distribute all of our income at the end of the year. So we do one annual distribution based on the income. We've had varied distribution. In 2019, we were able to distribute 10% because we had a sale and we had a very large income that year. We expect distributions to be around 1 to 2% in the next few years. But obviously, as we get larger and as we grow, that distribution will increase because it will offset our fixed costs. As you could imagine, as a trust, we have a lot of fixed costs. So as our income increases as we grow, and we've been growing steadily since we started, that distribution should increase.
An essence here, but I suppose the main advantage to the REIT structure versus the usual GP/LP is the tax benefits. And how do these differ basically to the USA tax benefits of REIT structures, or are the two countries basically the same?
First thing I would say as an ex-lawyer is that I cannot give you tax advice. So, but I can tell as a Canadian, it is tax efficient because it gets taxed once. So the trust isn't subject to tax by virtue of the fact that we distribute all of our income. So our income gets taxed at the hand of our investors. And because we've had, at least in the maybe this year or next year only, because we had some losses in the first few years, we're able to distribute that income as a return of capital, which is even better from a tax perspective. But in terms of U.S. taxes, I would suggest you get tax advice. I can't answer that question.
So where can we read the latest newsletter? I guess all the information of that sort you'll be able to get directly from you once they're
there's, if they go on our website, there is they could contact us, and our first question always is, are you a credit investor? And if they are, then we're able to send them newsletters and our deck. Another way, if they're ready to invest, there's actually there's a button where it's an online investment through our EMD, which is our exam market dealer, and they receive a call where they do kind of a number of questions to make sure they're credited, and they're able to invest that way as well. But I would suggest they contact us.
confirm that they're accredited, and I'll be happy to provide them with the newsletters and the investor deck.
I'm assuming there are some payments of dividends on the REIT shares. And what is your typical allowance for capital reserves for property improvements? 5%? Or is there a higher amount allowed for tax efficiency under CA REIT, Canadian REIT regulation?
So there's no regulation. There's our strategy. As I said, we have to, by law and by virtue of our structure, distribute all of our income. So any net income at the end of the year has to be distributed. There's no reserve that we could hold back. However, we're open for investments. So we have capital investments throughout the year. We have access to financing. We have lines of credit that's available to us. So be able to manage our developments and any redemptions, if there were to be, through use of those financial instruments, not through our income. Our income gets distributed.
Does all income get distributed, or is there an amount for capital reserves such as 5%, etc.?
All income gets distributed.
Okay, I guess this is about it. The last question is asking is, you guys are fundraising. Why did you decide to go with that platform as a private REIT? I guess that's why, but that's the last question I have here. And again, we will send all the information of how to contact you, Human, and the recorded session to everybody here. Anything else that you can add regarding your plans of growth, regarding the amounts of capital you'd like to see invested, regarding what you're planning to do in the next several years that you'd like to add?
Of course. So our constraint has always been capital. We are lucky, and I say we're lucky that we hold a very privileged position that we have access to a lot of opportunities. So our pipeline is full. I mean, it's full now. It's always been full, but there's more that we could do. So we are in the market to raise capital right now. We hope to be able to raise anywhere from $5 to $10 million over the next quarter. Because we see a lot of opportunities. We, as Kenny mentioned, that I don't want to stay away, but if there is to be a downturn, that's an opportunity for us to be able to hit our target cap rate. As I mentioned, we're very disciplined in the cap rate that we hit, and obviously, as Toronto prices rise, it gets more difficult to hit that cap rate. But we do see many opportunities right now in different neighborhoods, and we want to be able to take advantage of that. So right now, we're in the market to raise about $5 to $10 million. If there are folks on the call who are interested, I would respectfully ask that they get in touch with us, and I'll be happy to provide them with any information that they need.
Kenny, anything from you that?
I would just add it as coming from a family office and looking for places to put money. I think it's an excellent niche that is kind of fits very well in between all of the different asset classes. Now, nobody's looking to put money in bonds right now, and real estate is tough to get into. None of us want to be the ones in there plumbing the toilets or changing the shower curtains. It's a great way to get into that space. And sure, we're all going to be diversified and have equity portfolios, private equity portfolios. But from my perspective, I think it's a great niche to play in. If you're looking at a diverse portfolio.
I think, okay, the last is a remark, not a question, saying that this is a really cool REIT, love the model and focus, and seems like a great governance and management team.
Thank you.
So great. So Kenny and Human, thank you so much for joining us today and sharing your knowledge and thoughts about the real estate world. And hopefully we will be able to connect the interested investors with you guys. We'll send all the information. You'll get it by tomorrow, everybody, by 11. The system will send all the information plus the recorded session by tomorrow at the same time. And I am looking forward to seeing you in person, hopefully at one of our events in Canada. And thank you again.
Thank you, Danny. This was a pleasure.
Thanks for having us. Stay safe, everybody.
Thank you. Bye-bye.
Thank you.